All right, hello everyone. Hopefully you're on the short side of the market. We here are because it's been pretty obvious that this sell-off was coming. The market's been looking really weak, and it looks to me like the weakness is going to continue. So I would suspect some more downside. Now here we have the S&P 500 ETF or the SPY, right? It's called SPY because the symbol is SPY. It's a spider because it's a standard and poor's depository receipt. It's what we call an exchange traded fund. It tracks the performance of the S&P 500. Now, in the market, one of the main principles that there is, if you want to be a good trader, is to understand that some price levels just happen to be more important than others. And when a market gets to an important price level, it tends to reverse or break through. It tends not to just kind of hang out there for too long. For example, check out the S&P here. So this price level became important because it was support. Then a month later, or yeah, actually 2 months later, when we got back up there, it became resistance. Well, guess what? There were people who bought back here who thought that they were the new great hedge fund managers when the price went higher. But then when it lower, they're like, oh, a bunch of them are like, I made a mistake. If I can get out of this, I'm going to. So when the price got back up to their level, they were like, oh, I can get out of this at break even. I'm going to place my sell order at the same price I had my buy order at. So buyer's remorse can turn can turn support into resistance. Now, if I go down here, I really don't see anything that looks like it is an important price level until we get down to around 405. So I think the S&P's got a little bit of room to go. It doesn't sound like that much, but we're talking about the actual market as opposed to an individual stock. So for the market to go down about another 2%, that's not inconsequential. All right, now we're going to look at the second biggest or the biggest sector of the market. The S&P consists of 11 sectors, and the biggest is the tech sector. Now look at this. A lot of times we find support at former support levels, and this chart is actually a really good teaching lesson. So I'm going to go through this. Notice how, well, before we look at this, just remember some price levels are more important than others. Notice how back in January of 22 and December 21, this technology sector ETF hit resistance around the 176.50 level. Guess what? June of 23, where did it hit resistance? The exact same level, like within a dollar. Then resistance converted into support. That's because we got people who sold, who, when the price moves higher, they regret their decision. They say, I'm going to buy my shares back if I can get them for the same price I sold them at. So if you have enough remorseful sellers placing buy orders at the level that was resistance, resistance can turn into support. Here we see again, support can turn into resistance. Buyer's remorse, people buy, price goes lower. They're like, oh, I'm not so smart after all. If it gets back up to my level, I'm going to sell and get out at break even. So a big part of understanding trading is understanding which price levels are important. I know it seems kind of simple, but trading doesn't need to be complicated. Most people overthink it. It doesn't need to be that complicated. And I know I've been doing this for a long time. All right, so that's our tech sector. Next thing I want to look at is the financial sector, because this has been really an important driver. And look at what's happened here. This could be setting the stage for the next move lower in the broader markets. Remember, the S&P is 11 sectors. As a matter of fact, if we go to look at the Spider ETF fact sheet, so you just type in the symbol in SSGA for State Street Global Advisors. If we look at the holdings, here are our sectors: technology, healthcare, industrials, communication services. Different sectors are in the driver's seat at different times. Most of the time, utilities, materials, real estate, this doesn't really matter because they're pretty small, but energy could affect the market. Money could flow into consumer staples right before the market goes lower because of a flight to safety. And other times, these guys are in charge. I think right now, the most important thing is to watch is the financials. Now, check this out. All right, look where there was support around the 32.40 level. Now, the support seems to have broken. And what is happening? The support is converting into resistance. There's people who bought here who, once the price went lower, They're like, I made a mistake. I got to get out of this. And every time the price gets back up to the support level, the sellers sell and they push it lower. So when a support level converts into resistance, like here, it typically sets the stage for the next move lower. And I think that's what we're going to see here. And I think that's going to bring the broader markets lower. Now, an interesting thing to watch here is Amazon. Amazon is really breaking down. And this looks like there's a ways it can go. I mean, I'm going to be perfectly frank. I mean, not that I don't need to be or whatever. I just think the stock market looks very weak. Amazon broke support. It's heading lower. Probably get down to around 110. Tesla, another big name. It's breaking support. This thing looks like it could have a pretty quick move lower. See, when a market moves up really quickly through levels, it can move down really quickly through levels. Because as we talked about, one of the reasons why you get support is you get remorseful sellers trying to buy their shares back. When you blast through levels like this really quickly, there just isn't enough time for there to be this big vested interest of remorseful sellers to be concentrated around a price. So we could fall right back through that. All right, now here's a trade idea for you all. Oil. Look at where oil is. When things get to important price levels, they tend to break one way or the another. They tend not to hang out there for too long. This is oil. $1 trillion or trillions and trillions of dollars, markets all over the world, but yet somehow we find these clear support and resistance levels. And that's because if we're looking at the market, what you got to understand is we're looking at, don't think about it as looking at oil. Think about it as looking at the people that trade oil. What is their psychology? So there's people who bought back here who, when it went lower, they tell themselves, damn, if it ever gets back up to my price, I'm going to sell and get out. And then guess what? There's people who bought at resistance who say, oh, I bought, it went lower. If it ever gets back up to my price, I'm going to get out. So buyer's remorse can turn support into resistance. Buyer's remorse can also keep resistance intact for a long time. From a pure financial point of view, there's no logical reason why we should have support or resistance. But if you understand the psychology, it's very easy to understand why we have support and resistance. Why is oil at support now? Well, it was a resistance level. There are people who sold, price goes higher, and they say, I made a mistake. If it gets back to my level, I'm going to buy my oil back. If you have enough remorseful sellers placing buy orders, the level that was resistance, it becomes support. All right. So these are the things that I'm watching. Equities look pretty weak. I think this holding over in Israel could really just blow up pretty soon at any given moment. I think it's really sad that we have such a compromised, weak leader that it's literally leading to war around the world. Because everyone's like, all right, well, this guy's only got another year or two. Let's go in and do what we got to do now before, while we still can. And that's it, everybody. Thank you so much, and I hope to see you soon.